Welcome back. We are still at the Mopa Airport in Goa and in conversation with Saurabh Chawla. Saurabh, I wanted to get a sense from you regarding the Delhi tariff hike that you indicated. Give me a bit of a sneak peek as to what it could mean really for the business. What kind of upward revision are you expecting, the timeline, etc.?
Well, we've already filed for the tariff revision, and this is for the control period 5. And
which starts from when to when?
From 1st April 2024 for 5 years. So whatever tariff comes, it comes from a retrospective effect, taking into account the full time value of money. As I was indicating earlier, we have spent about 12,500 crores. So our regulated asset base has gone up almost 3 times. And on top of that, we have also won many claims and interpretations from the tribunal.
Okay.
So we expect that those will also be incorporated in this current tariff which comes. So minimum, I would say a 3x number of the current tariff should be there, if not more. You know, so it actually has a meaningful change to our P&L of Delhi Airport as we go forward.
So 3x is a sizable number, so I'm sure that's the most important thing that you're waiting out for. But talk about the non-aero part of business, because that too comes with good amount of margins, etc. for you and good scalability. Talk to me about what's the plan to increase that, and give me a bit of indication as to where the Indian spend is right now in terms of per person, and what is the global average, etc.
So we are actually trying to simplify our business model. We are creating a consumer company out of a utility company. From a utility company has an assured return on equity, which we get through our tariff.
Yeah.
But now with the non-aero part of it, and especially the retail and the duty free, we want to actually capture the consumer demand, which today's young and upwardly mobile and increasingly spendthrift consumer base is emerging. So how can we offer to these consumers that they spend at our airports? Just to give you some insight, today our spend per passenger in duty free is just $12, combined from Delhi and Hyderabad. In Dubai and Singapore, it's about $25.
Oh.
But Indian spending in Dubai is more than $40.
Okay.
Indian spending in Paris is more than 40 euros.
Talk to me about a few more consumer trends, in the sense, what's the breakup right now for international versus domestic passengers for you? And going forward, do you anticipate a higher growth in the non-aero revenue versus aero revenue? What will the contribution mix look like?
So it's very interesting. For example, in Delhi, which is a lot of international traffic is there, almost 70% of my revenues are coming from non-aero.
Oh, right? Wow, that's quite a bit.
And it's opposite in Hyderabad. So the focus in Hyderabad is how do we increase international flights, how do we increase the duty-free area and give that same optionality to consumers. In Delhi, the focus now and strategy is how to convert Delhi into a true hub, a hub like it is in Dubai, right? So all domestic to international, international to international flights, how do we attract those into Delhi airport so that consumers spend more time at the airport? Purchase at the airport is very impulsive, right? So you have the goodies available, it meets the eye, the person will go and spend, right? Nobody goes to the airport that, I'm going to buy this at this particular airport. It doesn't happen that way. So you have to, build on this psychological parameters. And also on the airline connectivity from international, domestic, international, domestic, which is a little lower spend, and international, which is also emerging. Very recent phenomena. Flights out of Sri Lanka coming to Delhi and then flying to Europe and the US, right? So we are offering that now. Additional, flights coming from Europe going to Australia instead of stopping over in
Singapore
Southeast Asia.
Else,
Why don't they stop over in Delhi?
Of course.
And airline connectivity, airline association. So, for example, Air India is part of Star Alliance. Singapore Air is part of Star Alliance. United Air is part of Star Alliance. So when you mesh all these associations, and create your airport as a destination hub, all these things will start to emerge. The spend will go up from $12 to $15 to $18. It's a natural migration growth that will happen. But you have to create that effort over there on the ground.
Fair, but for that, I think what you also need is a lot better connectivity and a lot more aircrafts. And if I have it right, that's a bit of a pressure point right now because demand-wise, there's enough. Supply side is a bit of a challenge.
Yeah, so airport are today full at the existing aircraft availability. Aircrafts are full. If you go to any flight, it's above 85% passenger load. But yes, supply of aircrafts are a little problematic because of disruption in the supply chain during COVID times. So it'll take some time that to emerge, but the trend line is positive. That's the main thing. And once these supply issues are behind us, I think you will see much better throughput in our airports, and that throughput purchasing more at our airports. That's the whole focus line.
Yeah, the focus is on more, and talking about more, traffic has been of course increasing for you quite steadily. You're already past the 100 million passenger mark. Talk to me about the growth rate going forward, because specifically talking about Q1, it was a bit soft. In July itself, in fact, we saw just 7.7% kind of growth. Do you anticipate, let's say, at least high teen figure by the end of the year?
Yeah, so I mean, on a secular basis, you will look at the growth around 12 to 15%.
That's in traffic.
That's in traffic, and that's how you should also, guide. We are not a Q-on-Q play. We will be always soft in the first quarter and will be doing very well in the last quarter. That's the seasonality in our business.
Fair.
So it's infra play is a long-term play, and very long-term investors, they become our shareholders. And those people who are looking at maybe 10 to 15 years as a time horizon is what they become our shareholders at. So that is what our focus is, to have the requisite elements in our business to attract such investors, and look at about 10 to 15% growth in our traffic, and because the operating leverages are already there, a much higher growth in the terms of revenue and profitability.
And what could that growth be, if I can try and get that number from you? In terms of revenue, it's still, I know it's a bit difficult to call, but at least on the profitability, because you're still in the red right now. You talked about operating leverage. Could we expect the company to turn profitable at the bottom line maybe 2 years out?
2 years will be a little too short. It will
Okay.
all depend upon what happens with the tariff order at Delhi. But I'm sure in next 3 to 5 years' time, GMR Airports at the platform level will be profitable. Hyderabad is already profitable. Hyderabad is in a position to give dividend to its shareholder, which is the listco for fiscal year 25. So I'm sure Delhi, once the new tariff order comes, will be in a position to start also giving dividends out in maybe 4th year of the new tariff period.
So yeah, given the fact that bulk of the capex is behind, is that something that we should factor in the debt as well, that the peak is over, and what will be the sustainable debt level from here on?
Yeah, so it's very important that the debt is actually looked at our asset levels.
Okay,
because each airport is a separate company. It has its own equity shareholders. The debt is ring fenced, and it is not to recourse to the listco. So, but having said that, you're absolutely right. On a consolidated basis, our debt levels will peak out next year, because we are already putting a new greenfield airport in Bhogapuram, for which it will be a combination of both debt and equity that will be used to build out that airport. So it will next year is when I think the debt should peak out.
Yeah, because analysts are expecting that your EBITDA can grow at least 2 to 3x over the next 3 years, and they're expecting you to turn free cash positive even from the equity side of things within a couple of years. Realistic?
Very realistic.
Okay.
Very realistic. And that's what our focus is. As I said, our whole focus is not to win airports at any cost. Our focus is become profitable at any cost.
But I just wanted to come back to the point that we were discussing on aero, non-aero revenue. Talk to me about the growth rates, because of course traffic is going to drive, and the tariff revision is going to drive the aero revenue, but what's the growth rate differential going to be like for the two?
So obviously the non-aero will grow much faster. We expect high teens of growth in the non-aero side of it, whereas little low to mid-teens on the aero side of it. Taking into account, of course, certain operation leverages that will play out over the next few years. So anything now above 15% growth is pretty much given in our play.
Thanks so much, Saurabh, for making time and speaking with us. Always a pleasure.
Thank you so much. Thank you for having us over.
Okay, so that was about GMR Airports and the way forward. But with that, it's a wrap on this conversation. Stay tuned to ET Now for more.